There's a moment most people don't talk about. It's not when you buy your first house. It's not when you hit six figures. It's not when your portfolio crosses 1 million. It's much smaller than that. It's the moment you check your bank account and nothing inside you flinches. No tension, no quick mental math, no silent panic about the next bill. Just calm. That shift doesn't happen at $1 million. For most people, it happens around 20,000. And not because 20,000 makes you rich, but because it makes you stable. Before you reach that level, money controls your nervous system. Every unexpected expense feels like a threat. Car repair, stress, medical bill, anxiety, job instability, fear. And when fear drives your decisions, you shrink. You accept lower pay. You avoid negotiation. You delay investing. You focus on survival instead of growth. Scarcity doesn't just affect your wallet, it affects your brain. Research in behavioral economics shows that financial stress reduces cognitive bandwidth. When you're worried about money, your mental performance drops, your long-term thinking weakens, your risk assessment becomes distorted. You're not bad with money, you're overloaded. Now imagine something different. You have 3 to 6 months of expenses saved. Rent, covered. Food, covered. Emergency, annoying, but manageable. Suddenly, the urgency disappears. You don't need the next paycheck to survive, and that changes everything. Instead of asking, how do I get through this month? You start asking, how do I build? That's the psychological turning point. And for many people, that number lands somewhere around $20,000. Let's talk math. If you invest $500 per month at 8% annually, in 10 years, you'll have roughly $90,000. In 20 years, that grows to nearly $300,000. Same contribution, same discipline, just time and compounding. But here's what most people miss. Compounding feels invisible at the beginning. When you invest your first $5,000, a 10% return is $500. Nice, but not life-changing. At $20,000, 10% is $2,000. Now we're talking. At $100,000, 8% is $8,000 per year. That's when your portfolio starts doing real work. The first milestone is about stability. The second is about acceleration. Your first $20,000 feels slow, painfully slow. It might take 18 months, maybe 2 years. You'll feel like nothing is happening. But once you cross it, momentum shifts, because now your money is participating. Your investments begin generating returns that shorten the timeline to your next milestone. Your second 20,000 takes less time. Your third takes even less. Eventually, growth starts to feel automatic, but only if you protect the foundation. Here's where most people sabotage themselves. They finally hit stability and immediately expand their lifestyle. New car, bigger apartment, higher recurring expenses. They mistake breathing room for spending power, and their fixed costs rise to meet their comfort level. They didn't gain security. They upgraded fragility. Now their safe number isn't 20,000 anymore. It's 35 or 50 or more. Lifestyle inflation quietly resets your progress, and most people never notice it happening. Think of 20,000 as your financial floor. Not a reward, not a vacation fund, not a shopping milestone. Your floor. You build above it, you invest above it, but you do not erase it. Because without a floor, every fall is catastrophic. With a floor, volatility becomes survivable, and survival is underrated in finance. Let's talk about leverage. When you have no savings, your employer has power. You can't leave. You can't negotiate aggressively. You can't take calculated risks. You're dependent. But with Runway, you negotiate differently. You ask for raises. You explore new opportunities. You say no when something feels wrong. And often, just having the option to walk away improves how others treat you. Confidence changes outcomes. And outcomes compound. Imagine you negotiate a $5,000 raise because you're not afraid to ask. Over 20 years, that single raise could represent over $100,000 in additional earnings. That's not investing alpha. That's psychological leverage. Financial fragility is the real enemy. If one emergency can wipe you out, you are exposed. It doesn't matter how high your income is. A person earning $150,000 per year with no savings is more fragile than someone earning $70,000 with 6 months saved. Income is speed, savings is armor, and armor determines how much risk you can survive. Now let's zoom out. Two people earn the same salary. Person A builds a $20,000 base. Person B never builds stability and lives paycheck to paycheck. 5 years later, the gap is noticeable. 10 years later, it's significant. 20 years later, their financial lives look completely different. Not because one was smarter, not because one had better investment picks, but because one had margin. Compounding rewards consistency. Instability resets progress. Every reset costs years. There's also a mental shift that happens once you cross stability. You stop obsessing over small expenses. You stop debating whether to skip coffee or downgrade cereal brands, because you realize those micro-optimizations won't determine your financial future. Instead, you focus on big levers: your savings rate, your housing cost, your income growth, your investment discipline. Big decisions move the needle. Small decisions make noise, and stability helps you see the difference. Let's run another example. $500 per month invested for 30 years at 8% becomes over $700,000. $700,000. That's not fantasy, that's mathematics. But only if you start. And only if you avoid resetting your progress. Every time you drain your savings for lifestyle upgrades, you restart the climb. And the first climb is always the hardest. Now here's the deeper psychological layer. Scarcity narrows your identity. You see yourself as someone trying to survive. Abundance, even moderate abundance, expands identity. You see yourself as someone building. When your identity changes, your behavior changes. You think in decades instead of weeks. You think in opportunity cost instead of monthly payments. You start asking, what is this decision worth in 20 years? Instead of, can I afford this right now? That shift is subtle, but it's powerful. $20,000 will not make you wealthy overnight. It won't impress anyone online. It won't change how strangers see you, but it will change how you see yourself. It gives you space. It gives you leverage. It gives you optionality. And optionality is one of the most valuable financial assets you can own. Because when you have options, you make better choices. And better choices compound faster than money ever could. So no, you don't need $1 million to begin feeling secure. You need enough to stop reacting, enough to build, enough to protect your downside while investing in your upside. For many people, that number starts around $20,000. Stability is step 1. Acceleration is step 2. And once you understand the foundation, the path forward becomes clearer. In the next video, we'll break down how to turn that first stable base into 100,000 faster than most people expect. Because once you stop surviving, you can finally start scaling. The real question is simple. Are you still reacting to money, or are you building leverage? There's one more layer to this that most people overlook. $20,000 doesn't just protect you from emergencies. It changes how you experience time. When you're financially unstable, time feels short. Every 2 weeks matters. Every bill cycle matters. Your world shrinks to the next paycheck. But when you have a buffer, time expands. You can think in quarters, in years, in decades. And wealth is built by people who think in decades, not days. This is why stability comes before scale. Because without stability, every market dip feels terrifying. Every unexpected expense feels catastrophic. And every opportunity feels too risky. But with a financial floor in place, volatility becomes tolerable. Risk becomes strategic. And patience becomes easier. And patience, more than anything else, is what allows compounding to do its work. Most people don't fail at building wealth because they lack intelligence. They fail because they never stay in the game long enough. $20,000 doesn't guarantee success, but it dramatically increases the odds that you won't quit. And in investing, not quitting is often the entire advantage.